Good afternoon and welcome to Level Up with HYCM. This is one of your exclusive free weekly workshops with myself, Giles Coughlin, and the idea is to help you guys level up so that you can trade in an independent way that is healthy and good for your long-term development. So let's just say hello to everyone. Hi Donya, hi again Emily, hi Fabian, Gerald, Kenneth, Nadir, Van, Zafar, Christoph, yeah, welcome to the webinar. It's good to have you around. If someone could just quickly mention in the questions or the chat to let me know that they can hear me okay, I would appreciate that, just so I know that you're receiving me through loud and clear. Let's just have a look if anyone, if you could just, the questions or the chat box. Yeah, thanks Emily, that's super. Great, you can hear me good. Okay, well, first of all, just a couple of explanations about what this leveling up workshop is. What I want to get you guys doing is actually getting involved with me as we go through this workshop. So if you've got your demo account, if you want to open that account up now, you can follow along some of the practical aspects of the workshop we're going to be doing today. We're going to be plotting moving averages. I'm going to be giving a little explanation about how to use them and how professional traders using moving average. It may be slightly different to what you're expecting. We're also going to look at placing different types of trade orders from the platform. So if you want to open up your demo trading account, do that now so that as we go through the week today, we can do some practical stuff. Okay, hi dear, hi Zafar, you missed the last two ones. Don't worry, if you miss anything in these webinars, they are all recorded. So you can follow up, and when I'm going through some explanations, don't worry if you miss something, you can just go through it at your own pace and have a look again at what's being said. So first of all, to say that this is these workshops are not trading advice. We're going to be looking at a number of different setups, and they're not intended as trading advice. They're literally intended to be education for you, to see the sort of places, the sort of factors, the sort of ways you manage risk that you would as a professional trader. And the idea is that you go away from this workshop with practical skills to put in place yourself. And to that end, you will see there's a handout at the bottom of your go-to webinar panel. You should see a section that says handouts. Can you just let me know if you've been able to see that? It's handouts, and if you open the handout, it will look like this. Okay, 6th of November, leveling up with HYCM, and there's 1, 2, 3, 4, 5, key aspects of trading. If you just make sure you can get that open, you will need that open as well. And you can see the reason I've done this handout for you is I wanted to get a handout that is helpful for you and practical. So I wanted it to be practical, so I didn't want it to be 5, 6, 7 pages long. I wanted it to be one page long as a kind of crib sheet, if you like, or a kind of the key things you need to look at whenever you come to your desk, whenever you're looking at trading. Okay, so that's why it's these 5 looking. There's looking back, looking forward, looking at the charts, looking at the risk, and then looking at the outcome of your trade. And the idea is that this is these concepts are important and necessary. So when you see this, this handout, don't just ignore it. Take it away, print it out, and the idea is that you use this for yourself, and you do the same process that we're going to be doing during this workshop, but you put it into practice. You do this when it comes to Wednesday, Thursday morning, Friday morning. This is the kind of way I'm going to be showing you how to trade intraday. So you can use exactly the same principles for trading swing trading on a weekly or a monthly basis. You use exactly the same principle. But the reason I want to show you an intraday way of doing it is because it's nice and easy, isn't it? Because I can easily talk you through that, and you also get a sense of how quickly the market moves, and that's just helpful for your development and experience. So make sure you have a look at those that handout, and that you've got it out in front of you. as I said, the extra value for this week is plotting moving averages and placing different types of trade orders. I'll go through the plotting moving averages first, so that then we can apply it on the charts when we're looking at it as we go through the session. So that's the way it's going to go. We're going to give you an introduction of the session. We're going to plot moving averages. Then we're going to look through the sheet and apply these principles to the last couple of trading sessions. And we're going to look at potential opportunities, and we're going to look at potential difficulties, and we're going to start to analyze the market, and you'll see how I do it, and you'll see how you can repeat that process for yourself. And once that's done, that will bring our session to a close. A couple of things to mention. We've gone through the outline of session ahead, and just wanted to mention as well that for those of you who are listening to me as I speak, so that is, the people I've mentioned before, plus Kenneth, Nadir, Jerry, Fabian. Well, what we have is every month, all the names of the people who are listening to the workshops as they occur. So this is not for people who are listening to a recording of this workshop. It's only for those who actually attend the workshop. Your names will be put forward into a raffle, and each month one person will win 1 hour of coaching one-to-one with myself. And obviously the benefits of the one-to-one coaching is that you can ask quite specific questions, and I can tailor things specifically to you and the level you're at, and I can, through a conversation with you, understand where you are in your trading journey and what's going to best help you get to that next level. However, this whole point of the workshop is to help as many people as possible. So if there's a topic that you really want covered, could I suggest that you just email it to workshop@hycm.com. I'm interested to hear from you. I want to know what you want covered. Obviously, one of the weaknesses of a webinar like this is that I get to speak a lot, and my communication with you is limited. I can't always tell what you're thinking, but obviously, yeah, hi Shiva, and I'm well, thank you. Yeah, use the question panel as we go along. Okay, don't be afraid to use that, and don't be afraid to use the chat, and I can get a sense of where you are and how things are going. Obviously, I won't be able to respond to every question. I'm sure you understand that. But when there's questions that are relevant that come up, I'll be able to reply to them. But again, email suggestions to workshop@hycm.com, and then I can look through, and we can look through the team and work out, what is the best next thing for you. Okay, we're going to go now to plotting moving averages. So if you can have your demo account open, I'll show you how we go about doing it. So here is a chart of the pound US dollar. Okay, so what we're going to do is we're going to go to charts, and we go to, now let me show you where this is. We want to go to insert indicators, and then you go to trend. Okay, so on your chart, go insert indicators trend. Okay, and then once you've done insert indicators trend, you move across to moving average. Okay, I'm just going to leave that there for a moment so that you can all see that. So insert indicators trend moving average. Is that clear to everyone? I'm just going to put my question box up to make sure. Yeah, okay. I'm glad that seems to be clear. So it's insert indicators trend moving average. And then once you've done that, you left click on the moving average button. Okay. And you will get the default settings of the moving average. Okay. Now, what you want to do, let's practice putting in a moving average that is of the 50 moving average. Okay, so 50, and then the moving averages that I have on my chart are the exponential moving average. you'll see that abbreviated to EMA. So this moving average, the 50 exponential moving average, is referred to as the EMA. Okay, you then go to your color, and there I've chosen my color there. And when I click OK, that is the moving average applied on the chart. So if let's see if I can get rid of that, and then we'll put it in again. So there's the indicator list on the main chart. We'll get rid of them all, and we'll put them all back on. Okay. So insert, indicators, trend, moving average, 50, exponential moving average, applying to the close. There we go. And then we go insert, indicators, trend, moving average, and now we have the 100 moving average, and it's the exponential moving average, and I'm going to put that color red. Actually, I use that as blue. So the 100 exponential moving average is blue, and I'm going to put my third moving average in, and that is the 200 exponential moving average, applies to the close, and it's a red. So there we have all of my moving averages on the chart. Now these three moving averages are very widely followed moving average. You'll often hear on analysts, reports, where prices in relation to the 200, the 100 moving average in particular. The 50 moving average is less reported. And the key thing to make you aware of is there's two key different types of moving averages that people most commonly use. This is the exponential moving average. And the exponential moving average is kind of like the fastest responding moving average. Okay, so it's the moving average that is the most responsive to price. And let me show you a comparison between the 200 exponential moving average and the 200 simple moving average. So let's go now. We'll go indicators, trend, moving average. And what we're going to apply now is the 200 SMA. Okay, this is the 200 SMA. I'm going to give it a nice bright color just so we can easily see the difference and easily distinguish it. So that's 200 simple moving average. So if this was abbreviated, it would be abbreviated to the SMA. Okay, there we go. And there we see the 200 SMA on the chart. So that's this red line is the 200 EMA. This green line is the 200 moving average SMA. So you see the exponential moving average, the red line, is more responsive to price than the simple moving average. It's due to the way they're calculated. They're calculated in a slightly different way. Let's just check everyone's okay with the question. Oh, okay, Shivo, you need some help. What are you struggling with there, Shivo? If you just want to put that in your message. Okay. Yeah, if you have any questions, just keep asking them. Okay, if you just type that in, Shiva, and I can try and help you. Returning back to the simple moving average. Now, on the larger time frames, so the dailies and the weeklies, there's more of a difference between the simple moving average and the exponential moving average on the larger time frames. As you get down to the smaller time frames, there's less of a difference between the two. So can you see that there's less of a difference here between the exponential moving average and the simple moving average on the charts there. Okay, but there is a difference nonetheless. So the key aspect to understand about these exponential and simple moving average is to do with speed of responding to price. Okay, so if you look at the daily chart here, we can see that the 200 moving average was respected here, here, and here, those last three places. And on the weekly chart, we can see, where is it? Yeah, that's it. On the weekly chart, we can see that it was the 200 simple moving average that was respected here and here, and price sort of, not quite ignored, but there wasn't so much of a reaction against the exponential moving average. So I'll leave it to you to decide which moving average you prefer to use. It really is a question of choice, because I'll explain why we use the moving averages, and that'll explain why it's not really that important which moving average you use. In fact, it's not really that important which technical strategy you use when trading. The key thing is to understand the fundamental reasons behind different trades. So I'm just gonna, I'll show you another little trick just before we go here. Right, so that's going back to my old template there. This is my standard template that I use, okay? Now, what you do here is, once you've got your template set up, what you do, you go to Insert, you go to Charts, Template, and then Save Template, okay? So when you go Save Template, and then you give your template a name, okay? So I will give this name HYCM test template, okay? You then save that template, and then once you say, let's say we want to open a new chart, we take a new chart up here, and instead of having to plot all over again all those moving averages, all you do is you go to Chart, Template, Load Template, and then go to HYCM test template, open, and then all the settings that you had on the old chart is applied to the new chart. I hope that makes sense. Let's just have a look. Is that, you just, okay. Okay, hi Shivo, you're new. That's great, Shivo. I'll be explaining what we're doing as we go through. Today what we're doing is we're plotting moving averages on our charts. So I want folks to understand some of the key technical aspects of trading as a good introduction for you. So make sure you're plotting these on your charts, and if you haven't got time to do it now, come back to your demo account later and go through the explanations. So by now what you should have is the 50, the 100, the 200 exponential moving average plotted on your charts. So now when someone refers to a daily 200 exponential moving average, this is what they mean. So on this chart, it's the daily chart. This is the 200 exponential moving average. So that would be the daily 200 EMA. Or this would be the 100 daily EMA. And this would be the 50 daily EMA. That's the way that analysts would refer to this. That just gives you a little bit of help with the lingo. Once you've set that up, you go to your charts, you go to template, you save that template, and I've given it that name, HYCM test. You just press save. I won't, because I've already done it here. Then when you go to a new chart, all you do is you double click on the chart, go to chart window, you go to charts, template, and then you simply pop on the saved template. You just either press load the template, or these are the ones that are that are part of that template, so you can just shortcut that and just go straight to your template name, press it, and then all the moving averages are plotted for you. That's just a time saver, because you can imagine trying to plot all the moving averages across 12, 14, 16 pairs. It's quite time consuming, so that's just a way of helping you to do that. Could you let me know, is that fairly clear? Have some of you managed to put the exponential moving averages on your chart? Could someone let me know whether they've been able to do that, just so I can know if you're managing to follow along with me? Okay. Okay. Have you all managed to do that? If you've, yes, okay, Nadir, thank you. I'm glad you've managed to do that. That's good. if there's any issues there's any issues you've had in putting the exponential moving average on, why don't you type me a question now and I can see if I can help you if you're struggling. But what I would say is you can always come back to this section and you can go over it again because it will be recorded. And if you struggle to do it for the first time around, come back and you can put these moving averages on. Now, the way professional traders use these moving averages is it gives traders a really key place to enter trades, okay? And what it does, it tells traders what the average price is. So, for example, in the pound US dollar chart here, it hasn't been a big surprise that the pound has wanting to be sold on the back of Brexit concerns. It's been a preoccupation of the market for some weeks now. And it's a key indication that when price returns to the average, that the reaction is going to be to sell from the average. Because if you think about it, if you have a bias to sell the pound, once price returns to an average price, you're going to see that this is my opportunity to sell. And this is the kind of places where professional traders are looking to sell. They get a bias for a currency pair. Okay, so in this instance, the bias might have been short pound US dollar. And rather than just, entering short instantly, professional traders look for a key place to enter and to go short. And so a place that would have made sense would have been a return to the moving averages. So a return to the 50 moving average, return to the 100, return to the 200 moving average, would have all provided opportunities for a professional trader to enter and initiate a short position. Okay, so the moving averages are good places to enter once you have a bias on your currency pair. We'll actually look later on in the session at the pound US dollar and what kind of opportunities there may be ahead with the current sentiment that's going on with the pound and the Brexit negotiations. But that's how professional traders use the moving averages. You've developed your bias, and then when you see a return to an average, you think, okay, well, if it's gone back to the average price, well, I know that actually I want to be selling the pound, so a return to an average is a very sensible place to initiate a trade. And you can see here how well respected the 200 moving average was. The 50 moving average found some resistance there. The 100 found a degree of resistance. You can see that as price broke down the 200, that the 100 and then the 50 provided more resistance, and then we can see the 50 providing support on the back of pound optimism, and then the obvious target is going to be up here to the 200 moving average. That's the sort of direction that we're heading in at the moment. Okay, just go back to see if everyone's managed to. Oh, okay, I can't save the market watch and terminal. Okay, so your market watch. Okay, Mo, let's just try and help you there. Where is market watch now? That is a good question. Yeah, so with market watch, go to view, Mo, and you click on market watch, go view, market watch, and then your market watch comes up. Okay. Does that help you, Mo? And then once you've got the market watch up, you just right click or double click depending on your computer, and then you open your chart window and then you load your saved template. Mo, did that help you okay? Oh, but it can't be saved. Okay, Mo, I'm not sure about that. Yeah, the saving that I've done is saving the template on the chart. You may just have to open up the market watch each time you open your terminal. I don't know why that's working like that for you, Mo, but I think you'll just have to, for now, open up the market watch. You can always get in touch with HYCM, see if you can get the answer for that, why it's not opening automatically. Maybe try closing it with it open, Mo, then reopening the platform and see if that solves it. Apart from that, I can't offer you any more help other than opening the market watch via the view panel there. Okay, great. Okay, that's good, Mo. I'm glad that's giving you a bit of help there. Yeah, good. Thanks, Mo, for asking. I don't want to have folks struggling with something like I can't open, I can't open a chart or I can't open a market watch, because that's going to be very frustrating for you. And I want this to be as helpful to you as possible. So do get in contact with me on the questions. Keep in touch. So that's the plotting moving averages. So by now we've all got the exponential moving averages, I'm assuming, plotted on the charts. We now come to the handout. Now, as I reminded folks earlier, the handout is there to help us to as a permanent sheet to apply every time you come to the markets. Okay, so this isn't just a handout for the sake of a handout. I've developed this handout to be practically useful. It's the things that you want to be doing as you come to the markets on your own without me. Remember, this workshop is not trading advice. It's all about education to help you do what I do for yourselves. So, okay, that is the workshop. So if you can just make sure you've got it open, just to remind you here. Okay, what we're going to be doing is we're going to have these 5 principles. We're going to look back, we're going to look forward, we're going to look at the charts, we're going to look at our risk, and we're going to look at the outcome of our trade. And that includes sentiment, fundamental analysis, technical analysis, risk analysis, and trading psychology. All of those key concepts are contained within this platform, within this outlook, and that's what we're going to go through. Just checking questions. Can you send the handout? Yeah, Mo, right. For those of you who just joined, the handout is found at the bottom of the GoToWebinar control panel. Okay, so go to the GoToWebinar control panel. You should see a tab that says handouts. Click on that arrow by handouts, and then you should see something called a workshop guide, 6th of November PDF. And you should be open that. Mo, have you managed to find that now? Yeah. Okay. So it's there on the GoToWebinar panel. Handouts, get workshop guide. Mo, I'm going to assume that you're okay with that. Yeah, oh, you've got it. Good man. That's super. So we've got our handout. And from this handout, we're going to start using the first section, which is looking back. Okay, so when we look back, we want to identify recent sentiment by reading up on the last 2 sessions of market activity. We're going to identify key market sentiment, and then the question is, can you summarize that sentiment in a sentence or 2? So this is going to be the workshop aspect of this. I'm going to go through some of the key aspects of sentiment that we have in the market, and then I'm going to ask you to try and summarize that sentiment in a sentence or 2. Okay, so you can enter that on the question panel in a minute, and I'm just going to take you through that. Okay, so now we're looking back, stage 1. Okay, so that's it, looking back. Now, what's that? Yeah, so I've just duplicated that. I'll get rid of that. Okay, so looking back. So let's look back at some of the key market events that we've seen. So we go to the HYCM calendar, and if you remember, if you were looking at the FX week ahead, I was mentioning that there was the Reserve Bank of Australia. The key data was coming out for, oh, hang on, let's have a look today. Let's just see if it's, is it all there? Yeah, that's it. Here it is. So the key data that was coming out was the Reserve Bank of Australia's rate statement and their interest rate decision. You can see that that has a high impact rating, and that's because that's widely followed. And market participants are looking carefully to see what the Reserve Bank of Australia are saying about their rates decision. Now, we covered this, and it was not expected for the Reserve Bank of Australia to change their interest rate at all. It was expected to stay at 1.5%. So if that is expected, why do traders look at the statement? Because what the market is always looking to see what's coming next. what's the difference? And so the rate statement was viewed by traders to say, are there any clues about the future path of the Reserve Bank of Australia's interest rate decision? Okay, so that happened overnight. So that's the key thing. When I woke up this morning, that's one of my first interests is, oh, what happened overnight while I was getting my beauty sleep? And this was some of the key information. There was no change in policy. Okay, so that is the number one issue. And this was via Reuters, one of the key news feeds that professional traders follow, Reuters, Bloomberg. And you can see that there was low rate. They were saying the low rates were supporting the economy. So in other words, they're going to keep those low rates. There's progress on unemployment. Inflation expected to be gradual, so reasonably optimistic turns. Housing markets have slowed. Credit conditions tighter than they have been for some time. GDP growth rised up a little. Australian dollar remaining in a range. The central scenario for inflation is 2.25% in 2019, a bit higher in 2020. And some analysts think that they're going to raise interest rates in 2019. And then there was other, the household consumption. One concern is the level of Australian debt. So that's a bit of uncertainty for the Australian economy. But as a whole, basically this is the key thing. No change in policy. There was a slight change with the rate statement, the way it was worded, but there wasn't a fundamental change in policy. Okay, so there wasn't really necessarily anything particularly to note. However, overnight, the other key thing you want to look at is what happened in the equity markets overnight. Well, the Nikkei, which is here, the N225. This is the Nikkei index, the Japanese equity index, and that was up 1.14%. So whenever you see something up or down 1%, that's kind of quite significant. Okay. This is a good indicator about whether the market is in a risk on mode or a risk off mode. So when the Nikkei, when you wake up in London open, you can see the Nikkei is up plus 1%. You think, oh, that's quite a risk on kind of mode. And when you're on a risk on mode, the market has certain characteristics. And one of those characteristics is commodity currencies tend to be bought. So commodity currency, Australian dollar, New Zealand dollar, that's what you're going to tend to see. That's going to be bought, and then you're going to see some of the risk off currencies being sold. So Japanese yen, Swiss franc. So just talking like that, you could suddenly see, okay, well, hang on, there's not much change for the Reserve Bank of Australia, but there is a bit of risk on tone coming into the market. So you might expect the Australian dollar to be supported in that scenario, and and you might expect the Japanese yen to be sold in that scenario. So one sort of key trade pair to have looked at would have been the Australia dollar Japanese yen. Now the market is changing now as we speak, and we'll come on to that as we're looking at it. But you can see that, okay, so the Australian dollar was gently bid. So if you took a view that you wanted to buy the Australian dollar Japanese yen pair for the intraday session, you might drop down to the 15-minute chart, and then you might choose a moving average to buy from. Okay, so you can either wait for price to return to the moving average like it did here. You can wait for it to return, and then you could say, okay, well, I'm going to enter once price closes above the 5 moving average, I'm going to enter 5 pips above, stop 5 pips below, and I'm going to aim for 10, 15, 20 points. Okay, that's one way of doing it. The other way you could say is I could try and enter along on the 100 moving average, and if you wanted to have a wider stop, the way to determine your stop on an intraday basis, I'll tell you a good way, is to use the average true range. So let me show you indicator. There's the average true range. Just have it ordinary settings, 14 settings. So you want to set stop. How much stop do you want to test? Well, here you go. The daily true range is 69 points. Okay, so that means for an intraday trade, you would be wanting to use somewhere between 50% and 25% of the average true range. So in this situation, if it was 70, 50% is 35. So somewhere between 25 and 35 point stop. So the other way of looking at you could enter a test of the 100 moving average, yeah, and then you could have had a stop of about 20 points, which would have taken you down. So 1.8 would have taken you down to roughly 9.8 down here, or you could have entered at this area, you know, at the big round number 81, and then had a 20, or just put your stop below the 200 exponential moving average there. That's the kind of ways you will want to be looking at trading. So once you identify that pair, so that would have been the sort of thing you would have been looking at this morning, okay, when you're waking up. So now we're now at the start of the US session, okay. So what we want to look at now is we want to look, we have what's going on we have the Australia. We can see now, we look at the equity markets, and let's see where we are now. Well, okay, interesting. We see the FTSE has dropped 0.5%. We've got the German DAX down 0.43%. We've got the S&P 500 futures, which is this symbol here. That is the US market. So we can see that the S&P 500 futures are down 0.22%. So okay, that what started in the Asian session as a risk on mood is now turning a little bit more risk off. Okay, so we can see there's a slight change in the markets. We look at some of the strongest currencies from the London session. We saw that, oh, that's what we expected, wasn't it? We saw the Australian dollar, the New Zealand, the commodity currencies being bid. Okay, they were being bought on the risk on tones, and the Japanese yen was only mildly bid, and the Swiss franc was very, very slightly offered, which is what we'd expect. And the Canadian dollar was sold quite a lot. Now, why was that? That was because of the oil prices. Okay, there is a big correlation. There's a big correlation between the price of oil, crude oil, and the US dollar Canadian dollar pair. Okay, so US crude prices at the moment is, I think I've got my oil crude prices up here. Yeah, it's 62.90. Okay, so it's just come off these earlier lows. Okay, so crude oil is being sold. There's been sanctions on Iran, but they haven't been as detrimental as expected on the supply of oil, and so oil prices kept falling. Last month is a very seasonal bad time for oil, and so oil has just sold. It's been in this deep downtrend since, you know, early October, and you know, it's just sold all the way down through the 100 moving average, through the 200 moving average, and it's just even more on its way down. So the correlation between oil and Canadian dollar is the US dollar Canadian dollar pair is about 96%. So what would you expect to see with the crude oil falling? You'd expect to see the Canadian dollar being sold, which is what you do see. And when you go to the US dollar Canadian dollar pair, let's just find where that is. Where are you? Where are you, US dollar Canadian dollar pair? Just open up a new chart, it's easier. Oh, it's the wrong one. There we go. Open up a new. And see, it's loading the template. Just put my template on. Lovely, done. And see what you expect to see. You'd expect to see the US dollar Canadian dollar being bought, you see, because the Canadian dollar being sold results in US dollar Canadian dollar strength. Okay, so we now have kind of a key inflection point for the US dollar Canadian dollar. You can see that we're sort of hitting a trend line there. There's a little trend line from those two places there, and price is finding some resistance. And but what we're expecting to see if oil prices recover. So So if oil prices recover, so they're 63.14. If that keeps going up, then you're going to see the Canadian dollar being bid, which means you're going to see the US dollar, Canadian dollar being sold. Okay, so now we go down to the 15-minute chart, and we start to see, okay, an interesting place. Okay, so we're seeing this kind of line from the highs up there, and we're seeing price approaching this 50 exponential moving average. And looking at the hourly chart, yeah, in the hourly chart we have a kind of a trend line across the hourly chart. We see resistance there. So look, now you can start to see, if you wanted to develop a trade here, say you're watching the markets and you think the price of oil is going to continue to recover, then the sort of thing you want to do is you would put a stop just above this trend line there. So you could enter here, you could sell by market. Just wait for this to come through. It's being a bit slow. Let's give it a second. Okay, let's try again. Okay, that's being very slow. We'll just keep an eye on that and we'll come back to that later. You would sell at market there and you'd place your stop just above those highs there, and you could be playing down into these lows here. So that's just one example of what you could be doing, and that's just based upon the price of oil, okay? Because the US dollar, Canadian dollar pair is very highly correlated. But obviously, if you see oil continue to fall, then what you can see is that price is likely to break out of this area, and then you can see it's going to try for those top levels again there. So that's just one way of doing that. Sorry, that's my very messy screen. Now let's go back to the workshop here. Okay, so we're looking back in that London session still, and there we could see that the Canadian dollar was being sold, and that was linked to the price of oil. Okay, so already we've started to see, okay, well, that would be a good opportunity for trading in the future, potentially looking at the price of oil, US dollar, Canadian dollar. We saw the pound was being gently bid as well, and the reason for the pound being, we've covered this in the FX week ahead a number of times, is that there's so many different headlines about Brexit. Pounds up, pounds down on different headlines. We've just seen exactly the same today. So first of all, this headline from one of the members of the DUP, which is the Northern Irish government, basically putting as it were the hard line, saying we have to have no border in Northern Ireland. It's absolutely we can't make any compromises. So that was seen as a no-deal Brexit suddenly becoming more likely. Okay, so that saw the pound drop about 40 points this morning, and then the UK's Brexit minister Dominic Raab sent the pound higher because he came out of a cabinet meeting giving the thumbs up. Okay, so then all of a sudden the pound rallied. So yeah, that's, if you wondered, do traders trade everything? Well, this is even trading a thumbs up. So even hand signals are being traded here, and I'll show you how that worked. Oh yeah, we've got the sell limit in there, and we would just drop the stop above the high, and you could make a play down to those lows, and that's like 2 or 3. Again, that's not trading advice, but that's just showing you the kind of places you can do. You can see that trend line, anything, if price goes above that trend line, you're wrong, and obviously the price of oil is going to be key in that. We'll just get rid of that one that hasn't got the stop on. Okay, so that came through just while I was doing that. Right, okay, so we are going to the pound US dollar chart. Now here was the moves, the pound US dollar chart. So okay, we'll go to the 15-minute chart. This was the drop from the DUP, thinking a no-deal Brexit is imminent, and then this was Dominic Raab's positive thumbs up. Where we are in the Brexit wider picture is helpful for us, because we're in a situation, we're in exactly the same situation before, when Britain is trying to gather some optimism about managing to arrange a deal with the EU. Okay, so at the moment the market's feeling optimistic about a deal being arranged. We've been here before, and we've been in a situation. It was here in early October. I was looking to sell from the 200 moving average as price increased, and I think we're heading potentially for another test of the 200 moving average. Because I think what we're going to see is we're going to see the cabinet getting encouraged. Theresa May saying, you know, me and Raab have got it. We're going to work out a new arrangement that the EU is going to like. So I think the pound is most likely to rally onto that news and then find some resistance here around the 200 exponential moving average. And then the question is going to be, will the EU accept what Dominic Raab and Theresa May have said? And then even if they do accept it, will the British cabinet then vote positively on the deal? So there is a tremendous amount of uncertainty still to come with this situation. So the key place to short is this 200 exponential moving average. So you know, a trade that I've got on at the moment is I'm looking to short from there. So I've got a pending order to sell at the big round number 1.32, and I got a stop loss 1.3285. Okay, so there. So that's the sort of place I want to, and I just want to get it a little bit further down, just so that if I get a touch of that moving average, I'm higher, and I've got my stops nice and high above that high there. That's the sort of thing that I'm looking for there. Okay, now that is because the cabinet aren't meeting again this week. I expect more optimism to gather. Now, if you are taking, you know, another, say you think that optimism is going to carry on, the place you would want to enter the trade would be just like around this 100 exponential moving average. Again, this isn't trading advice, this is education. Say you were convinced that yeah, I think that the optimism is going to carry on. You maybe think, well, I think that Britain is going to get a deal with the EU and that this is the moment. You know, if that was the case, you would watch this daily candle. If it closes above the 100 exponential moving average, you could enter it with, you know, like a stop just below this candle low here, or even a little bit tighter, and you could enter playing for a test of that 200 exponential moving average. That would be the obvious place to enter, because if you see, like, you've got a trend line there, you know, from these highs to there. It's not quite drawn accurately, but you get the point. And there's a 200 exponential moving average there, so that would be an obvious target. So then you've got to make, you know, think, does the trade, is the reward worth the risk? That's something you would have to work out. But so that's the other data we had out. We had Spain's PMI data out in the London session. That was a surprise of 54 versus 51.8. So that was a little bit of good news. Now, these PMI data are surveys. They're surveys of key executives who work for, you know, 300, 400 plus companies, and they ask them things like, you know, what's your inventory level like? What's your order level like? What's your employment like? What's your production? And they ask them things like, you know, is it better or worse than expected, or about the same as you're expecting? Just very simple questions, and then they give them a rating of like of somewhere between 0 and 100. Now, anything above 50 is seen as positive, anything below 50 is seen as negative. So this Spain's PMI data, remember, it's just survey information, so it's not hard data, it's just a survey of the key executives working at the companies, and they say, yeah, okay, so that's good. So that was a slight uptick for the euro. But okay, so we had the Germany and the Eurozone. Look, you can see it's 54.7, 53.7. So Germany's beat expectations, and the Eurozone beat expectations. But you know, when you look at that in context, here's Germany's PMI, here's Eurozone's PMI. You can see, look, like the trend is heading down, it's heading lower. So when you put that all together, you can see, oh, that's not actually as great as you might think. So there's pressure on the euro, but what we have to remember is, okay, we've looked back, and after looking back, we then want to now look forward. And there's one event that is really, really, kind of hanging over the whole market today, and it is the US midterm elections. Okay, so US midterm elections. Okay, setting the path for US dollar. So at the moment, the market's just waiting for these. The polls are taking place, and a quick, catch up on this is in the US, the collective government is called Congress, and Congress consists of two houses. It consists of the House of Representatives and the Senate. And all 435 seats of the House of Representatives are up for election. And it's expected that the Democrats, which is the opposition party to Trump's Republican Party, that the Democrats will gain control of the House of Representatives. Currently, Republicans have the Senate and the House of Representatives. So what's expected to happen is this: House of Representatives is to switch from Republican control to Democrat control. Okay. The significance of that is that Donald Trump is going to find it harder to push his American first policies through. Okay, so any more fiscal stimulus, infrastructure spending, healthcare cuts, that's going to be hard for him to push through now, because it was previously in a Republican control. So if it switches to Democrat, which is what's anticipated, then that's going to clip his wings, if you like. It's going to restrict some of his ability to put various policies through. The Senate is expected to remain in Republican control, rather. Now, the difference between the two houses is that the House of Representatives, all 435 seats are up for grabs. In the Senate, there's only 35 seats, I think it is, up for grabs out of 100. Okay, so the potential for change in the Senate is restricted due to the nature. I think you serve 6-term office, if I've got this right, in the Senate, and then there's a kind of rotating election of every 2 years, 1/3 of the Senate get elected. So in other words, you can't have a total, washout of the Senate in any one go. And I can sort of see the wisdom in that, so you don't swing too much with the other house, depending on the mood of the country. But that's by the by. The bottom line is, what's expected is that the House of Representatives will go to Democrat control, Senate will remain in Republican control. So that's what the market's focused on. And if that changes, say both houses go to Democrat control, then we're going to see in the short term the US dollar is going to fall. Okay, and that will mean like pairs like the euro US dollar, the pound US dollar will appreciate. Okay, so that is one aspect to really be aware of. If there's a surprise election result, it's going to have an impact. So you can either be, staying up looking at the results, or you need to be factoring it in for your trading. So, for example, for myself and the pound US dollar trade that I have on here, I won't go to bed leaving that on, because I know that if the US election results are a big surprise, I know that, and say the Democrats win both houses, then there could be a big spike in the pound as the US dollar gets sold. Okay, so I want to be, very aware of that. And similarly, if I was trading the election result, the interesting pair to trade is the US dollar Japanese yen. Okay, it's got a small spread, it's got a high volume of trading activity, and it's a pair that will be, that will be highly observed during the election results. So that's something to be really factoring in. You can see the dollar's selling off. There's some of that is with that risk off tone that's coming into the market. Remember what's happened with the risk off tone. You're going to see the Japanese yen being bought. So we can see that the US dollar Japanese yen pair is being sold off as the yen's being bought against the dollar. So that is something to look at. So the results are coming out as we look forward about from about midnight GMT time tonight, and I think that's about, that's about 7 p.m. Eastern Standard Time, 11 p.m. Eastern Standard Time, from, as the poll comes in. So basically midnight tonight GMT, the early exit polls will start to come in. So that tells you that any trading you have, you don't want to be leaving positions open with such a volatile risk. Now, nothing might happen. Things could have happened as expected, but equally, there may be some significant reaction as well. So that's a key part of looking forward. So on that basis, they're some of the factors you want to look at, but they're the long-term trades that I see. Is like the pound US dollar short makes sense on the Brexit negotiation. I think US dollar Canadian dollar pair is worth looking at, particularly in the price of oil. So I think that's okay. So you can see oil is increasing. If you just take these pivots off, and as oil increases, you're going to see the Canadian dollar appreciate as well. So you'd be keeping an eye on oil charts there. You can see it's appreciating here, and then you'd be looking here at the 64 level, at the 100 exponential moving average, and that will give you an indication of what's happening nearer term with the US dollar Canadian dollar pair. But that's that's a fairly sensible place to find. You limit your risk, and obviously as price drops down into that 100, 250 exponential moving average, that would be a key place to evaluate your trade, because you're likely to find some resistance levels there at that point. But you've defined, you've limited your risk, you know what you're doing, and that brings us nicely onto the next aspect of our session, which is I'll show you the handout again. So we've looked back, we've looked forward, we've looked at the charts, we've done that as we've gone along. We've looked for key technical places to enter, placed orders, we've developed our bias. We've looked at our risk. So the event risk is the US midterm elections. So we've decided we want to pull out before they're released. If you're trading the midterm election, we recognize what the tradable events are, is that if both houses fall to the Democrats, that will be a blow for the Republicans, and that will be US dollar bearish and equities bearish. Looking at your risk, you always want to risk. You don't want to lose leverage when you're trading. Now, you might find that strange, but that will help you not to be irrational. It will help you to be calm, and it's also how I trade from my funds account. I only would ever use 1 to 2 leverage. Okay, so that's that's not what I'm going to be. So you must look at your risk. So we'll look at the risk as we enter a trade. We're now going to come into the next aspect, and in this next aspect, we want to be looking at how to place our trades. So if you pull up your demo account, okay. Oh, okay, that's great, Fabian. Yeah, I'm glad you can follow that now. Okay, so if you want to just pull up your demo account, in this account here, you've got a balance of roughly 100,000 euros. Okay, so with a balance of roughly 100,000 euros, what you want to do is, in order to trade without leverage, you would be trading one lot. Okay, so in order to place a trade, you go to new order, and if you want to enter a sell or a buy order exactly where price is, you would press the sell or buy by market. Okay, so if you're selling the market, you would press sell. If you're buying, you would press buy. Now, the ideal for this situation is that you enter a stop loss in as you enter the market. Okay, so for example, let's say we wanted to trade here, and let's say we wanted to enter just say, for the sake of argument, we're entering a trade here. We will put our stop at 1.3140, and when you press sell by market, we would have the sell and the stop loss will go in at the same time. So you would just sell by market, and there you have. You've got your sell and your stop in at the same time. Now it's preferable to put your sell and stop in at the same time, because you've got your stop in as soon as you enter your market. So this is when you're buying or selling by market, and all buying or selling by market means is buying at the price where it currently is. Okay, so a couple of things to check when you're buying or selling by market. Okay, you want to check what is the spread. Now the spread is the difference between the ask, the bid, and the ask price. So you see here, you've got the first price 1.3122, and you've got the second price 1.31240. So the spread is the difference between those two. So that is approximately 1.2, 1.3 points. So that's acceptable. So now the thing is, if there was some volatility in the market, you can see that spread can increase. It can be like 10, 15, 20 points. Okay. In volatile market situations, that's very normal, and it's part of the broker's way of covering themselves with the risk, and the market only offers certain prices in risky times. And that makes sense, doesn't it? Or else everyone would just be entering, trades very, very riskily, big risk events with a minimum risk. So you've got to bear in mind yourself what the spread is. So always check the spread. You check whether you're selling or you're buying. You check your volume. So in this instance, I traded one lot, which is no leverage. My balance is 100,000. My volume was 100,000. So that's trading without leverage. Say you had a current account of like, say, 10,000 US dollars, then you will be trading one mini lot. 0.10 mini lot would be trading without leverage. Okay. That's what you will be looking at doing there. Okay, so that is how you buy or sell by market. Nice and simple. The other way of trading, if you wanted to trade very quickly, you just click the charts and you go to one-click trading. And when you go to one-click trading, you can just sell or you can buy just by clicking the chart. And then when you do that, when you click on the chart, you can drag your stop from the actual chart. So in this instance, you can see here, okay, if you click on the entrance and then you drag, you're moving your stop. Okay, so you can move your stop by just dragging the chart across. Nice and simple. And in the same way, you can create a take profit. So if you have you click on the entrance line, and you might just pull it down to there, and then that becomes your exit area as well. Okay, so I'm just going to show you that. I'm just going to take this off, and then I'm going to show you how to do it. So you have one-click trading. You would just quickly decide, oh, I really want to enter this chart, enter this trade. You've got your lot size there. You pop it in, make sure that's what you're happy to risk. You press sell, and then you can quickly drag your stop above the highs, and then drag your take profit down to the lows. Quite simple and quite easy to do. So that's just another option. Now, the other way of entering a trade, now we'll go to a different pair because that's getting quite busy on the screen. We'll look at the pound US dollar pair. We'll take this out. So here, say we want to sell from a level that's higher. All we do, we go to new order. We would then go to type, and we want to have a pending order. That's a pending means it's waiting. And what we want to do is we want to sell on limit. Okay, so selling limit is when you want to sell above price. Buy limit is when you want to buy below price. Okay, so you sell limit, and it's 1.32 and 1.3285. And it's always good practice to put this take profit as well, 1.28, just in case you get a big movement in price. And there you have all your orders entered. That's how you do that. So you wanted to buy below price, you would just go to new order, pending order, buy limit, and you just put your 1.2800, 1.2700, and you just place it there like that, and then that's your buy limit down there. Okay. The final type of order is your sell limit and your sell stop. So your sell stop and your buy on stop. So that is literally So here you would buy on stop when you're buying above price. Okay, so this is when, say you wanted to try and trade a breakout, you would have buy on stop, which means as soon as price goes above that level, we'll put it 1.3100, put stop as 1.3050. You press there, and then that's your buy on stop order is placed there. And similarly, if you wanted to sell on stop, say, you might think, oh, I want to be in a place that's a good place in case there's some more bad Brexit headlines that come out. So in that case, you might think, oh, market execution, I've got my volume is correct, pending order, I'm going to sell on stop, and it's going to be 1.300, and my stop loss is 1.3017, and this is when you're wanting to sell below price. Okay, so very quick summary is as follows. If you're buying on stop, that's when you're buying above price. If you're selling on stop, that's when you're selling below price. Sell limit is when you're selling above price. A buy limit is when you're buying below price. A market order is when you're buying at current price. Whenever you're buying at market, always check your spread. You always want to make sure. So you might go, you can find your spread in the market watch chart over here. Okay, so just check, that's GP US dollars. Just open that open, we can see, look, the bid is 1.3073, the ask is 1.3074, so the spread is by 1.1 points. That's acceptable. You want to be looking for the danger times when it's like 10, 15 points, because it really will affect your trading and your bottom line. Imagine if you've only got a stop of 20 points and the spread is 15 points, price only has to move 5 points against you and you'll be stopped out. It's that simple. So be careful, particularly outside of popular market hours. So times to really be careful are times like, start of the session on Sunday evening, some of the overnight Asian sessions, close of the US markets. You can see spreads widen. That's standard, it's normal. No one's playing tricks on you. That's just the way the market is. So try to, particularly if you're trading intraday, trade within the key market hours is going to give you the best opportunity and the best hope with that. Okay, I think that is reaching the end of our session. I hope that this. Okay, Fabian, in a very practical way, how much lot size can one transact? Okay, now my aim here is to teach you how to trade in a way that's going to help you trade for a long time. Okay. And help you trade profitably. So what my recommendation is, and it's the way I trade professionally for a fund, so that gives you an expectation of what a professional trader does, is my lot size matches my balance size. So Fabian, if you had 1,000 US dollars in your account, then you'd only be trading with 0.01 micro lot. Now that might seem, that seems too little. Well, Fabian, when you learn to trade professionally and when you can generate a good, stable return on an account, you will have no problem with investors, putting more money into your account, and money will find you once you can trade professionally and stably with a minimal drawdown. Okay, so you want to focus on a minimal drawdown. Can you imagine that, a high net worth individual doesn't want to see 10, 15, 20, 30% drawdown in their account? 2, 3, 4, 5, 6% is kind of acceptable. 10, 15, 20, 25, 30% is not acceptable. So that's what you have to bear in mind, Fabian. It's not what can I trade, it's what I should trade. And the basic rule of thumb is don't use leverage. So try to allow as little leverage as possible. There are times when you can use leverage in certain situations, but as a general rule, you don't want to be trading leverage if you can help it. Okay, I hope that helps you, Fabian. Yeah, okay. So if you had 3,000 US dollars Kenneth, particularly if you're starting and you're trading out, what you want to do is you want to be trading 0.03 lots. Okay, so that'll be 0.03 micro lots. And you might think, oh, that doesn't sound very much, but it's so key for your psychology. If you're losing 300, 500, 600 US dollars in a trade, two things are going to happen. One, you're not going to be able to think properly. Two, you're going to lose your account very, very quickly. So it's no good, like, what part of the reason that HYCM have put this workshop on is to help traders trade successfully for as long as possible. The longer you trade and the better you are at trading, the better it is for HYCM. Okay, so there's no good just coming in and blowing your account in a couple of weeks. It's no good. So that 3,000 US dollars, 0.03 micro lots, and then as you grow in confidence and you start to get better, then you can have more money into your accounts because you become more consistent, you're more confident, and you're not going to have big drawdowns. You're not going to have big psychological issues of I've lost a trade. If you've lost 0.5% of your account, it's not too bad. It's okay. It's okay. I hope that makes sense. We can look at this in more detail if people want to, and I can explain the reasons, but it has a big impact on your psychology that is not obvious when you first start trading, and it's not obvious to those who haven't done it. Okay, once you've done it, you'll start to see, and a lot of this is born out of experience, and particularly if you want to be in this for a long term, you need to guard your capital, because or else what will happen is when you're starting out to trade, you'll lose your capital, and then once you've lost your capital, well, then the whole trading aspect becomes pretty pointless for you. So preserving your capital, and then there are occasions when you can use leverage, and we can maybe cover that another time, but for now, your basic rule of thumb, don't use leverage. And as I said, I don't use it on my professional account. I'm not really, I can use leveraged 1 to 2. So in my account, I can just use kind of, I'm unleveraged nearly all the time, and the maximum I'm allowed to use is 1 to 2 leverage. So if that gives you an indication of what professional traders are doing, maybe that'll be a bit of an eye opener for you, and then you can see some of the percentage returns that you're looking at is quite different from what you might initially expect. Okay, guys, I've really enjoyed. I really hope that has that been helpful for you? Oh, good. Yeah, that's right. It's 0.03. You got it. Fabian, you're welcome. Thanks to you too. Guys, it's been a pleasure. I'm looking forward to doing another webinar with you guys, and we are going to be, where we're going to be next time. We're going to be live market analysis, not on the 5th, it's on the 12th. 12:30 to 1 GMT. We'll be looking ahead at what's coming next week, so do join me on that. It'd be great to see you there. Nice to see some of you at the live market analysis and also here at the workshop. This is going to be 1 p.m. GMT every Tuesday, live market analysis, practicing your online trading skills. Oh, good. Yeah, I'm glad that. Thank you. Guys, thank you very much for your feedback, Fabian, the dear Kenneth. I'm glad, Zafar. Kenneth, I'm glad you're improved now. It's really my sincere desire to really help you guys. I'm not just going through the motions, so please do get in contact with HYCM. Here's that address again. If there's any issues you're struggling with or want help with, HYCM.com. Remember the one-to-one coaching that will be available for people who attend the webinar, the workshop like you have, and then one person will win the raffle and get one-to-one coaching with myself. But anyone can email topics to workshop@hycm.com. So take a note of that email address, send your topics in, and hopefully we can get them covered. Okay, it'd be really good. Thank you very much for today. I've gone a little bit over time, but I think it's been worth it. Okay, guys, have a good day, and I look forward to seeing some of you next week and at the workshop and at the FX week ahead. Okay, take care, guys. Have a good day. Bye.